Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Anjoy Foods Group Co. Limited annual report. Anjoy Foods Group Co. Limited offers a diverse range of businesses and services in the food industry. At its core, the company specializes in quick frozen food products, which include prepared foods, dishes, noodles, rice products, hot pot and barbecue foods, semi-finished dishes, and rice and flour products. The company's comprehensive offerings cater to various aspects of the food supply chain, from research and development to production, wholesaling, retailing, and sales. This extensive range of services enables Anjoy Foods Group Co. Limited to provide a one-stop solution for its customers' quick frozen food needs. Anjoy Foods Group Co. Limited market capitalization of $37 billion is significantly larger than the average industry peer of roughly $3 billion. This shows that Anjoy Foods Group Co. Limited holds a significant advantage in their industry. Anjoy Foods Group Co. Limited trades at a higher price-to-earnings ratio of 15 times and a higher price-to-book ratio of 1.53 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 24% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 3.96%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be summarized into several key areas. Revenue growth drivers. The company's revenue has grown significantly due to the expansion into new product categories, particularly frozen bakery business segment. The development of strategic signature products, such as Lock Fresh product line, has also contributed to increased profitability and brand influence. Omnichannel sales and market expansion have further boosted revenue growth. Additionally, the introduction of new retail modes, leveraging big data and deep integration between online and offline services, has driven e-commerce model growth. The company's focus on technological innovation and R&D efforts has led to product quality improvement, brand reputation enhancement, and economies of scale through multi-channel coverage and market share expansion. The digitalization and intelligence initiatives have also contributed to revenue growth. Revenue decline drivers. On the other hand, the decline in revenue can be attributed to several factors. The decrease in revenue from quick frozen flour and rice products has been a significant contributor to the decline. Economic headwinds and significant fluctuations in material prices have also affected revenue. Furthermore, the reduction of unnecessary food additives and decrease in sales of certain traditional products have contributed to the decline. The company's efforts to reduce costs by eliminating inefficient suppliers and developing high-quality, new resources have also led to a decrease in revenue from some segments. However, these efforts are expected to lead to long-term benefits for the company. Net income experienced fluctuations between 2024 and 2029. Initially, it decreased by 8.46% in 2025 compared to the previous year. However, it increased by 9.4% from 2024 to 2029. The net income also saw a significant increase of 15.6% in one of the years during this period. The growth in net income can be attributed to various factors, such as growing demand for quick frozen prepared foods expansion of the catering industry, and household demand growth. Despite some fluctuations, the overall trend indicates an upward trajectory for net income. Profit margins, on the other hand, underwent a mixed performance. Initially, they decreased due to operating income increasing by 7.05%, while net profit attributable to shareholders decreased. However, with enhanced innovation capabilities and quality upgrades of quick frozen food products, profit margins improved. Despite these improvements, gross profit margin and operating profit margin saw a decline in some years. The decrease was attributed to factors such as increased depreciation of fixed assets and higher costs of raw materials, particularly for crayfish. The company's financial performance indicates a consistent generation of positive operating cash flow. According to the extracted summaries, the net cash flows generated from operating activities have been steadily increasing over the years, with RMB million, 316,000, 723,000 in 2025, and RMB million, 103,000, 845,000 in 2024. This trend is further supported by the increase in cash at bank and on hand, suggesting a positive operating cash flow trend. The company's ability to generate positive operating cash flow is a significant indicator of its financial health and stability. It suggests that the company is able to cover its operational expenses and invest in growth initiatives without relying heavily on external financing. Overall, the data points to a strong financial position for the company, with a consistent generation of positive operating cash flow. The company's financial health has undergone significant changes over the past year. A notable shift is observed in its debt level, which has increased substantially from 2024 to 2025. The total liabilities have risen by $1,758,337,417, while short-term borrowings have skyrocketed by a staggering 800% from $111 million to $890 million. This surge in debt has had a direct impact on the company's interest expenses. In 2024, the interest expenses stood at RMB 1,540,461.26, but this figure has more than tenfold in 2025, reaching RMB 17,449,346.99. This significant increase in interest expenses is a clear indication of the company's growing debt burden and its associated financial implications. The performance of various segments and regions in the quick frozen food industry has been analyzed. Among these, China stands out as a notable performer. The country's quick frozen food industry has shown significant growth, indicating a strong market demand. In addition to China, both domestic and international markets have also performed well. This suggests that the company's products are not only in high demand within its own borders, but also have a global appeal. Overall, these results indicate a positive trend for the quick frozen food industry as a whole. Management is emphasizing innovation-driven growth as a key strategy for aligning with national goals. This involves accelerating globalization efforts while achieving coordinated development in scale and quality. The company aims to expand its presence in both domestic and international markets, particularly in the halal food sector through its new Anjoy brand. To achieve this, management is focusing on enhancing brand influence and maintaining steady growth in its core business. This includes proactively expanding into new industries and integrating businesses to consolidate its position as a leader in China's quick frozen food industry. The company also plans to establish a global supply chain platform by targeting high-growth or large-scale overseas markets. In addition, management is shifting its focus from channel-based branding to deep cultivation of consumer brands. This strategic shift aims to drive long-term growth and increase the company's competitiveness in the market. The company's financial performance is reflected in its dividend payments, which demonstrate a commitment to returning value to shareholders. According to the provided information, the company has indeed paid dividends, indicating a focus on shareholder returns. On page 53, it is specified that the company paid RM0.44 per share, providing a clear indication of the amount distributed to investors. This detail highlights the company's efforts to reward its shareholders through dividend payments. Furthermore, page 54 reiterates this information, confirming that dividends were indeed paid out. The payment of dividends suggests that the company has generated sufficient profits to distribute a portion of them back to its shareholders. This practice is often seen as a positive sign for investors, indicating a stable and profitable business model. Inventory buildup and supply chain disruption concerns. There are growing concerns about inventory buildup in the industry. The reliance on distributors has led to a risk of excessive stockpiling, which can be detrimental to business operations. This issue is further exacerbated by rising costs, making it challenging for companies to manage their inventory effectively. Moreover, potential supply chain disruptions pose another significant threat. The force majeure clause, which allows parties to cancel contracts due to unforeseen circumstances, highlights the vulnerability of the supply chain. Rising costs and other external factors can trigger this clause, leading to a disruption in the supply chain and impacting business operations. That concludes the financial summary for Anjoy Foods Group Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.